2023 is already shaping up to be a defining year for crypto. Zero-knowledge proofs, NFT infrastructure, and advances in Web3 gaming all present once-in-a-decade opportunities, according to some. But the real significance may lie elsewhere, in regulation. Governments and governing authorities everywhere are cracking down on crypto. The US has just seen a landmark decision passed down by the SEC on crypto exchange Kraken, and elsewhere, countries like Australia and South Korea are moving forwards aggressively with new rules for the sector. Make sure you check out our recent video, by the way, on what's going on in those places. Now, the timing of all of this has a lot of significance, and there are pros and cons to being first in setting these new rules. What's clear for the whole of crypto is that those working and investing in it just want to know where they stand. So are regulators doing enough to help both investors and the industry understand what's going on? Well, in this video, we're going to take a look at the latest moves in the UK and in Europe, and we're going to start with what's going on in London. At the start of February, the UK's Finance Ministry said it was setting out plans for crypto that would provide clarity to consumers and to businesses. The approach, the government said, would be consistent with its attitude to traditional finance. The Bank of England has also just laid out plans for a digital pound. It said it's taking things slowly and the UK CBDC won't actually be issued until at least 2025. But Britain has some big plans for crypto in the meantime. Just before Terra Luna crashed last year, the UK's then Finance Minister and now Prime Minister, Rishi Sunak, had said that it was his ambition to, quote, make the UK a global hub for crypto asset technology.
So there are certainly some jurisdictions that are looking at that and seeing that opportunity and wanting to set themselves up as sort of a hub for blockchain companies, for blockchain startups to be founded in and grow and those sorts of things. There's a second sort of race going on, which is in the wake of a lot of the sort of blow-ups last year. So I think a lot of jurisdictions are afraid of being made to sort of look like fools.
There's good reason to think the UK could yet become a crypto hub. London's historic position as a centre of global banking and its geographical location between the US and Asia already puts the city in a strong position. That's according to Bradley Duke from ETC Group.
There's a lot of skills there around banking. People have been, working there, and also the supporting industries. The legal industry, which is of course essential for any any kind of banking endeavor. And also the FCA has historically a really good reputation as being a fair regulator and a good regulator.
This reputation hasn't quite helped crypto yet, however. The Financial Conduct Authority has, in fact, repeatedly warned investors in the UK about the risks that crypto poses. For instance, it's only just said that it will come down harshly on any crypto advertising which breaks its rules.
They've been quite standoffish, saying, on the one hand, making videos saying people should be careful about, investing in crypto, and also but at the same time failing to regulate and to take those steps to actually bring or put in place a regulatory framework for crypto.
Now, this attitude seems to chime with others that we've seen adopted elsewhere. Singapore's monetary authority made very similar warnings just last year. The city-state has been trying to establish itself as a crypto centre as well. Lily King from Kobo says it's this sort of clarity on rules, though, which will ultimately help people feel more secure.
It's considered to have very stable policy towards a rule of law, as well as the sensible decisions making made by their government from top down.
The European Union is also trying to establish this sort of clarity for the sector. The key framework for the EU is something called MiCA, the Markets in Crypto Assets rules, currently being voted on by its members. It was originally proposed in 2020, and the bill is meant to create a set of rules allowing registered crypto service providers to sell products right across the whole block. The coverage of these rules is big, and not everyone agrees with what's in them. People like Gary Weinstein, for instance, have called for revisions of parts of the proposed regulation on the grounds of concerns about innovation, privacy, and security. Now, Binance is also reportedly seeking a lobbyist to try and influence what's going on in the EU, and they could be in for a bit of a long wait on that. The decision on MiCA has been pushed back again, supposedly to April because of technical issues to do with translations. Caroline Malcolm from Chainalysis recently told us that while MiCA is important, it's still all theoretical.
That process of implementation is always really important. A lot of the devil is in the detail, and so we're still waiting to see how a lot of these rules will actually work in practice.
Lawmakers in Brussels have also recently backed a draft bill on crypto reserves for banks. Any institution will soon have a 2% capital limit for its crypto holdings, but they would also have to hold €1 in capital for every euro of crypto that they held as well. While some in Europe have sounded more dovish messages on crypto, Bradley says that the message from these new capital rules is a bit more mixed.
It's good that they're recognizing crypto is part of treasury policy in banks, and that that this is an asset class that people want to, that banks want to hold, as part of their capital. And I think previously there had been a kind of a 1% limit or guideline, I think in prior years. So a move towards 2%, you could argue, is positive. They're just doubling the limit, but it feels very cautious.
EU decision-making has long been derided for its difficulty and for its duration, and it was a regular talking point, for instance, during the Brexit referendum and subsequent negotiations with the UK leaving. While there are proponents and critics of the moves that are being made in Brussels, insofar as crypto is concerned, some are more focused on things that are being done right, not necessarily done right now.
One of the weaknesses of the European Union is the fact that it is made up of 27 countries, and to get consensus across all these countries, everyone pulling in different directions, it's like herding cats, and it's very challenging. And I think to arrive at something like MiCA, I think, is to be applauded because it's difficult.
The issues that the EU and the UK are trying to deal with are, of course, the same as those being dealt with everywhere else. Different places, though, seem to be taking different paths. And this begs the question, what is that going to mean for crypto across the world?
These assets are sort of multi-jurisdictional, particularly the true sort of open source public tokens, particularly network tokens. It's very, very hard to sort of contain these within a particular jurisdiction. So, ideally, we would avoid certain different, jurisdictions, going in very different directions.
If we talk about unified regulation for the whole world for this, it's not easy actually, but because every country has its regulations, has its way, has its policies. It's not easy to have all countries agree about something.
Whatever approaches are being taken, Bradley said that the most important thing is that governments and regulators everywhere think carefully about what could happen if they clamp down too hard.
I don't want the magic of crypto to be regulated away. This is an area where there's so much innovation, there's so much opportunity, and to do things better, to have a more democratized banking system.
Alright, that's it for this video. Do make sure that you like and subscribe to our content. We've got plenty more to come on regulation, and it is going to be a big year for that in crypto. If you have any comments on what's happening in the sector and about our reporting on it, please let us know in the comments below or wherever you're watching this video.